Hello, dear professor. I'm going to give a presentation on my dissertation. My name is Zalin Li. My supervisor's name is Telmo. My dissertation title is Stock Market Forecasting Using Interval Symbolic Data Analysis. First, I'd like to introduce my project with a background. The combination of finance and datasets has seen a revival with the rise of automated and high-frequency trading. Symbolic data analysis, especially interval symbolic data analysis, short as ISDA, has arisen as an innovative strategy to streamline stock predictions by reducing data complexity. When it comes to motivation, the integration of ISDA with prevalent models like ARIMA and LSTM is relatively unexplored, representing a significant research gap. So, the objective of our model is, first, explore and evaluate the integration of ISDA with ARIMA and LSTM to optimize stock market predictions. Second, compare the forecasting capabilities of ARIMA and LSTM when applied to interval symbolic data. Third, assess the efficiency of interval symbolic data analysis in improving stock market prediction accuracy. Well, next, I want to take the first step of my project. Is data processing. We sourced Apple stock data from Yahoo Finance and segmented it into daily intervals. Where the stock trend is generally stable, significantly volatility is noted on some days. When it comes to the models we used, I'd like to introduce the ARIMA model to you. The table describes the characteristics of the autocorrelation function, short as ACF, and the partial autocorrelation function, short as PACF, for three different types of time series models. AR means autoregression, MA means moving average, and ARMA means autoregression with moving average. We also use ADF test to select D. These characteristics are commonly used for model identification. In time series analysis, we can look at the plots or numerical values of the ACF and PACF to guide us in selecting the most appropriate model for our data. Well, the next model is LSTM model. LSTM is a specialized form of RNN that tackles long-term dependencies through the addition of cell state. LSTM's unique gate mechanism dynamically adjusts the self-recurrent weights, allowing for the controlled flow and decay of features. In short, LSTM's gates and cell state enhance its ability to manage information over extended periods. Next, we use the Bayes optimization to adjust our LSTM model, focusing on three key hyperparameters. They are numbers of neurons, dropout ratio, and learning rate. Our training and validation losses, measured by MSE, showed distinct trend but converged after the third approach, indicating a robust model fit. With the model collaborated, the next step involves fitting it to our prediction dataset and comparing the robust and accuracy. When comparing the three models, we observe that the ARIMA model outperforms the others, demonstrating superior performance. The LSTM model also delivers commended results, showing its efficiency. However, the baseline model significantly lags behind, with unsatisfactory performance. In the last, we see the results and make a conclusion. Comparing the performance of different trading strategies under different forecasting models. They all start with $100,000. Let me introduce the normal strategy first. If the forecasted price for the next day is greater than today's price and no stocks are currently held, we allocate all availability funds to purchase shares. Conversely, if the forecasted price for the next day is lower than today's price and stocks are held, we will sell all the holdings. Next is the interval strategy. If the next day's forecasted low price surpasses the current day's high price, we hold on no stocks. We allocate the entirety of our capital to purchase shares. Conversely, if the next day's forecasted high price falls below the current day's low price and stocks are held, we will sell them all. In conclusion, in the ARIMA model, the normal strategy represents a 6.02 increase from the initial investment of $100,000, and the interval trade strategy represents a 8.33% increase from the initial investment. In the LSTM model, the normal strategy represents a 16.12% increase from the initial investment of $100,000, and the interval trade strategy represents a 80.82 increase from the initial investment. It is very clear that LSTM model performs better than the ARIMA model, and the interval trade strategy performed better than the normal trade strategy. And the further investigation revealed that while LSTM did not outperform ARIMA in terms of overall performance, it was more sensitive in catching fluctuation in data trend, which likely contribute its greater rate of return. Finally, there is still some work that can be done to improve our project. The first is employing a larger dataset. Using a larger dataset provided more training experience for the model, reducing the risk of underfitting. The second is utilizing diverse datasets. The insights generated from a particular dataset may have had a random or unique component. The third is developing additional trading strategies. Aside from creating traditional signals based on the maximum and minimum values within an interval, further technologies based on the interval's midpoint may have been developed. That's all. Thank you for your listening.